one of the things that I wanted to dive in with you is I wanted to discuss the kind of the concept of outside in. So we were talking off before we had the headphones on and stuff, telling you a little bit about a podcast episode we did with somebody who was on the inside of the industry and went out and became an advisor. And here we've got a situation where we've got a successful advisor who goes, and I'm curious about how you came to this, but goes from being outside and comes in, and by coming in, you are now constructing and building funds.
Right.
And so I am so curious to hear a little bit about that journey and what made you do that, because you must have seen something that was lacking that you weren't liking. So let's start with a little bit of your background. So you are here, not too far, middle of the country.
Right. Yeah, the capital, Missouri, Jefferson City.
Jeff City, and you were running. You were a little more 401k, or were you more individual?
Well, it was really both, but because I came into the business right out of college, it was really hard to earn the trust and respect of successful people, and that's who you want to work with and help, as a financial advisor. But I found that they would give me an opportunity to win on service and price in their business, and usually they're focused on, can you help my employees? And kind of a bad kept secret in that business is there's a lot of advisors who lose track of those clients, and so initially it's I'm going to be there every quarter. And then it's every 6 months, and then it's every year, and then it's every other year. And so I was able to do the easy things well, which is just show up and do what you said you were going to do. And after a while, that would lend itself to not just helping the employees of the business, but those business owners. And now also became a really nice referral network. So I used 401k as a way of, I think, reaching everyday America where they retire, but it was also the back door into working with wealthier, successful business owners.
Now so as a former advisor, to me, when I would look at 401k, it seemed like something that if you're going to be a 401k advisor, you need to be a 401k advisor. You can't just dip your toe in.
There's no halfway in. So you definitely I had to commit to understanding that language, the terminology, the rules, tracking legislation. I mean, it is where America goes to retire. So it seems like every session of Congress, someone is proposing a turn in the road. So I'd agree. You have to commit to being an expert in that space. But once you learn it, it's not so different than having a specialty within any other wealth management practice. And I meet very few advisors who can't do a couple of things really well, or don't have some type of specialty within their wealth practice. So it just became second nature, once you committed to understanding that business. But you're right. I've tried to coach some people away who say something like, I'm going to try that. I'm like, it's not how this works. It's like exercise. You either do or you don't.
Yeah. How different does the 401k marketplace look from when you started in it to where it is now?
Well, the service model, obviously everyone had to adapt with COVID. So how do you serve people virtually? It was very much a executive room table, a lunchroom table. Is one of the things that I miss about being an advisor. I mean, because you meet people of all walks of life, all industry. Never got my hands as dirty as Mike Rowe, but it was neat in that there's so many ways to make a living, and so you got to visit with people of every walk of life, and literally see kind of how America works. So I really enjoyed going into these businesses. That's usually how you met with them. So I think that was the leap or the connectivity that advisors had to figure out during COVID. But unfortunately, the opportunity for advisors is still there because there's still plenty of the financial literacy gap is still monumentous. It's huge. So people need help and hand-holding. The retirement gap, the number of people who are not on track to retire, is still way too big. So the problem is still there, and the opportunity for good advisors to assist hasn't changed.
I just saw an article on that when I was scrolling through when I was getting ready for bed last night on the fact that there are so many people that, for so many people, the 401k, the plan through work, whatever they have, that is their one real shot at retirement. Otherwise, they're not really doing anything. And so many people don't have that access. And the literacy is a huge issue. When you would meet with people, did you find a lot of people were really interested, or were they just kind of going through the motions?
I think it depends on the age of the individual. Reality hits everyone in the face when they start realizing, I'm going to get of an age where I don't want to do this anymore. So the closer you were to your body wearing out, I think the more serious the individual you were working with tended to be about something next. But it's the hardest thing to get employers to understand was usually the employer wanted to offer a great plan to their employee, but did not understand the influence that they had over the individual's ability to save. And what I mean by that is simple plan features. Like I was a big proponent of auto enrollment and auto increase because people are failing to retire on time, largely because we're just not saving enough. Like as an example, if you can get a 10% savings rate in your 401k, that's a pretty good achievement if you can get an individual to part with 10% of their paycheck to put into savings and investment. But if you compare that to like Missouri's teacher retirement plan, they have about 31% of their overall savings going into the pension by rule, about a little over 15 from their own contribution by law and a little over 15 from taxpayers by law. And so, you talk about how does one get a sustained pension?
You got to feed it.
You got to feed it first. And so that's one of the things that it was always kind of a struggle or a push and pull with employers. I don't want to make someone enroll. Well, you make them show up to work at a certain time. They go home to see their family at a certain time based on your dictation when they're going to celebrate Christmas or holidays based on your policies. And so it's just kind of a train of thought that and employees trust their employer. And so it's one of those, hey, no, this is a helpful thing. Get them started via this opt-out process.
How many places do that?
It's I forget this. The American Retirement Association does a really good job of being an advocate for that plan and also putting stats out. And it's been a bit since I've looked at those stats meaningfully. But auto enrollment and auto escalation are two trends that are going in the right direction. There is a wider group of employers who are adopting those features as an example. But it's not that much different. I mean, you see technology come in. It's like, tech, we're going to save the day. But there's some fancier websites and apps are certainly easier to use to see your balance. But this year's been a crummy year, and that hasn't been fixed. Target date funds have thrown. I mean, the 2025 target date fund was supposed to be a conservative vintage for conservative investors. Well, it's peak to trough had a 35% drawdown at one point this year. So. The investor experience, the trust in Wall Street and getting people where they need to be, again, lots of opportunity. None of that has really changed.
I was looking at, I saw another article that talked a little bit about the amount of people that are tapping into their 401k's and using that money for hardships. You think that'll continue to be an area that they expand access, or should we be limiting that?
No, I think it's good to expand that opportunity. I mean, I think one of it's your money. You worked for it, and we certainly have a system where it's on you. No one's coming to be your hero, and that ultimate accountability is hard to absorb sometimes. But I do think that people have a tendency to trust in systems where there are exits often. And so I think that was Secure Act 1.0. And I forget what the official name of that legislation was. Secure Act 2.0 is being considered now. We have divided Congress, so I'm sure to be a piece of hostage weaponry that gets used to pass something else in the future. But I would expect that you're going to see more ability to access plans, especially in times of hardship, like a pandemic or loss of job. And a good advisor, I think, would consult the client not to use that as the first choice of funds, but the ability to do it is probably a good thing. I think that builds trust that, hey, this is a two-way door. Why not save into it?
Oh,
I think that's a
good,
more important thing.
That's a good point. I never thought of it from that perspective of letting people know that it's not a one-way street of funds going out of your paycheck that you can never use really until you get to retirement. But that does make sense, that if there is accessibility, it might make me more likely to contribute more funds.
Yeah, we talk about business decisions that build in terms of one-way versus two-way doors. How long should we study this? If it's a two-way door, probably requires less study, less time. But if it's a one-way door, more study, and that's exactly right. And so when you put the proverbial gun to someone's head and say, sign up for this plan, you can't see this money for a very long time into the future. Time will tell whether adoption rates go up because of these features. And in a pinch, it's got to come from somewhere. So, again, a studied advisor can probably help an individual make that the best decision for them. But why not give them the choice?
Yeah. So curiosity question. Do you miss it? Besides meeting people, I know you said you miss meeting people like that.
I dearly miss that part of it. I had a situation in my neighborhood where something was going to be constructed or was proposed to be constructed in the neighborhood by a neighbor outside of code, and I was very against it. This was right next door to me.
Yeah.
And so I had to, walk door to door and meet with some of my neighbors. This is at our farm, and so these people aren't as close as, living right next door to someone in a cul-de-sac. But it forced me to do more than just the farmer wave. I think you guys do that in Kansas too, right?
Yep.
Two-finger hello. And I just sat down at kitchen tables with people, and once we got past, that's no good for the neighborhood. It was just tell me about you, and then it was tell me about the farm and how did you get here, and so I really did that. I went home after that. And I just told my wife, I said I really missed that part of being an advisor, and one of my mentors in the business encouraged me, especially early in my career, to go meet people on their terms where they're comfortable. And what I found and what he was trying to teach me was that folks are most comfortable in their own setting, in their own castle. And so you get more truth and information from them oftentimes at a kitchen table than you do in a fancy conference room or something like that. And that part of it I definitely miss. It's a different challenge. And so I think they're both kind of their own equal adversary, building a fund complex and distributing versus working with individuals. I think one of the harder parts about fund distribution that I loathe is that it is harder to get consensus as the new guy. As being the fund manager, than it is getting consensus from the individual that they trust, like you, and believe they can work with you. Yeah. So the buying decision process and the sales cycle is quite different, and one that I think is harder, frankly, than being an individual advisor.
Let's set the table here, because we actually jumped ahead a little bit without for the benefit of the viewers and podcast listeners. So you go from 401k advisor, personal advisory assets, and you see an opportunity to, and then we're going to come back to what you were saying, because that's interesting. But so you're there as a 401k advisor. You're there as an individual advisor to your clientele, and then walk us to where one day something popped in your head that as you're looking through funds, you're like, doggone it, I could do that better. Where did that come from? So just for the audience, you have now formed, make sure I get it right, but Build Asset Management, and you are building funds.
Right. Tell
us a little bit about that, and then we'll circle back to how you got there.
Well, so
who is Build Asset Management? What are you guys doing?
Well, Build Asset Management specializes in intelligently designed risk mitigation solutions that we believe are more repeatable for downside protection with meaningful growth opportunities than what has existed in the industry previously.
Okay.
And so our niche, the world doesn't need more fund managers to make it a better place. BlackRock and Vanguard have done an excellent job of indexing everything. And so you don't need to exist if you need to have a better index. At least we don't have that idea. So you have to have differentiated value no matter what you do. And we think our differentiated value really is on that marrying the two needs of conservative investors, which is I can't afford to lose what I have worked so hard to amass. And at the same time, and this is a real thing now, it wasn't when we were thinking about build, but we anticipated, as part of the story, we anticipated some changes ahead. But not only do you have to live off of what you've assembled, that nest egg that you built up, but now you've got this inflation charge, beating you in the face consistently too. So net, I've got to be conservative and yet make enough to beat this headwind of inflation and sustain.
Sustains. I think I've said this probably a million times in this podcast already. I still think after all these years being in the business, we've all seen that doggone inflation slide that pops up and it shows, bred in 1952 and you roll your eyes because yes, a movie ticket when I was a kid, and so you almost, it's almost just white noise. And then all of a sudden we have this year. And all of a sudden, when it comes to talking about inflation with clients, I think we have everyone's attention on something we should have been paying attention to before. But all of a sudden, it's like, because if you look at inflation and you look back to the last time there was inflation like this, anybody retiring would have if they were retiring right now, maybe they would have been in high school and they would have been worried about who they're asking to the prom and what's going to the game on Friday night, because that would have been the late 70s to instead of what their parents were dealing with, which was inflation at that time. But so you see this issue, you decide, hey, I'm going to hang up the Spurs. Did you hang up the Spurs on the 401k side, or you still got them? Still wearing them?
No, I did. So first, I had the great benefit of having great mentors. So time matters. What happened to you and when.
Sure,
puts those scars and those impressions on you. And so I know it's going to pain you, and then make the other half of your audience really happy. But so I was a University of Missouri graduate in 2008.
In all fairness, and the reason John said that, in all fairness, is the University of Missouri is no, I'm just kidding. That is a great college. They used to be in the conference of the school that I went to. But yes, no, I miss them in our conference so badly.
And you got the better up in basketball the other
We did smoke
other
you
week.
guys
Congratulations.
This year. Yes,
thank you.
But I don't play, so it doesn't matter.
It was a few years. But you helped us sell out our arena for the first time in a long time. So rivalry is good for a lot of things.
That's right.
But so I graduate from MU in 2008, right? I've got a business background, and so you're going into the business school, and everything's falling apart, and jobs offers are being deferred. I mean, this is my class, right? I've got a cousin and friends in third year law school, that had offers from big firms, and even law students are being deferred. So the whole thing's melting down.
There's nowhere to go with funds.
And I'm still that generation with the promise of, it's more about having a degree even than having the skill, that you're, and so you're watching kind of this, the string is long, but you're wondering how much further it can be pulled to get everything unwound. I was lucky to have a risk management class where I really was like God was saying to me, like, hey, dummy, you ought to maybe focus on this. It was the only class I ever set a curve in, on anything. And so that got me really interested in insurance and investments. And I decided, I also like entrepreneurship and I can control my own destiny doing this. And so I started out on my own and linked up with a group in Jefferson City, these Wall Street Group advisors. And I had some really just good people who took me in, saw that I had some of the things that are harder to teach, like just drive and desire, and then taught me the other things I didn't know. And through that, gave me an opportunity to become a partner in this firm. And so before I left Build, I had checked a lot of the boxes that I wanted to accomplish professionally and personally, and providing for our family, and feeling like I have a professional standing and doing good for clients in the community. So I had no reason to leave doing that. I didn't have it figured out, but I was on the S-curve trajectory that I was hoping for. What was hard to swallow, so to speak, is 2008 and everything that we did during that time. And I say we, everyone who's involved in any type of commerce or as a taxpayer, we rewarded bad behavior, and it really felt like we were papering over something that we hadn't totally dealt with. Now it's interesting because I think that's part of what we're feeling over the last 2 years of this pain is some of that's coming back to roost, and some of that is the inflation that you're feeling. But we went into a ZIRP's world, zero interest rate policy, right, to construct artificial growth, in the economy. And again, most of the people that you're working with, you asked earlier, how different is 401k and how seriously does people take it? My answer was the closer you got to realizing your body was going to wear out, the more serious you took it. And so it's those conservative clients who are nearing retirement where you just looked at them and said, okay, zero interest rate policy world does not support 60-40. Markowitz didn't have this in mind when he designed that and won a Nobel Prize. Even the safer things, the index annuity world was seeing that, hey, these rates are hard to support if we can't back that with treasuries that are going to do better than this guy. So, give us some help here. And it forced everyone out onto the risk curve. And it just felt like, okay, very bad things happen to you eventually, if you accept that. And so this just inspired curiosity. It led to conversations with a friend of mine, actually from high school, who'd take his path was in quantitative finance. And so when we talk industry, just as friends, we'd kind of geek out on this observation that the next 40 years weren't going to be the last 40 years, where you could just see this price appreciation in bonds. You're going to get this idea that there's no inflation is dead, and we're not going to have inflation again. You were hearing people sing Keynes's praise. Hey, we just Keynesian economics. That's the way to do this. And our thought process was, no way does this movie end well. So how do you help conservative clients? And what I did as an advisor, an independent advisor, I went and looked for that solution. Right. I was looking for something that provided reasonable defense with appealing upside potential without the lockup provisions that come with some of the products that have those type of features. So how can we do that in a daily tradable way to complement those buckets of money is how advisors talk to clients oftentimes, your liquid bucket, your illiquid bucket, and so forth. And the rabbit hole of how do we get there in this conversation with a friend ultimately led to, Matt was at Amazon at the time doing some interesting things there. I was a partner in this practice. And we said, hey, if we can convince our wives that they can go on for this journey and experiment, then let's go start a company. And so the name Build came from this idea, one, of constructing returns in a way that were thoughtfully designed, and two, to inspire people. This is I was a walk-on at Mizzou for the football team when I was there, and retirement doesn't happen by accident. I think exercise and sports comes to mind a lot for me, as examples of the intentional nature that you have to take to retire or to have financial security, because you have to work at it. It doesn't happen by accident. But it's tough, and so you also, best coaches are a little bit of both. They give you a truth serum, but then they kind of build you up. And so this idea of Build asset management was born, and we're getting really close to our 3-year track record on the first fund that we launched. Oh, nice. January 28th of 2020. And so we launched this business just before the world shut down. Yep. And so to my comment earlier, it's made distribution tough. Sure. And I think that world is changing very quickly. But we're pleased. We feel like the strategy is doing what it was designed to do. And a lot of what's happening now, we don't have a crystal ball. We try to be humble. We built something we think is also humbly designed to be malleable for the times ahead. But we're making this up as we go. And so not to beat down on, Jerome Powell, but there's no book for this. And I think that's part of what I was struggling with in 2008. You're used to anyone who gives you information, the news anchor. This person's very smart. They're telling you the news. And the facts are all the books that I had to read at that time to get securities licensed were premised on a totally different world. And even in that literature, the test, and the answers that you have to click to get the answer right, in those test questions are predicated oftentimes on a belief, the right answer was built on 1960.
Yeah, exactly.
This was different. This was different, and so you're going to get different things happening. And
I think that on a lot of things that they say, like in the military, they say that one of the problems is we in peacetime we prepare to fight the last war. Mm-hmm. And I think that's a great
analogy.
Yeah, I've got this thought that in a lot of what we do, I've got this feeling that we're preparing for our father's retirement.
Right.
And it's a different world going forward, because we're going to end up talking about Bitcoin here at some point, because that's going to cross our conversation. But so you see these things that are lacking. You go out, you start this company. Clearly the wives bought in, because the company's off and going.
They're still with us.
They're still with you. So talk a little bit about the difference then so you start, and it is challenging because there are so many more offerings on any side of the fence.
Right.
I'm a rep too. So when I look at what's over on the non-registered side, what's coming out, I get to talk to the carriers over there, and it's new this, new that, and the fun side, new this, new that. How do you fight through the noise? Because there is some parallel here to being an advisor on one hand.
Oh, absolutely.
But talk to us a little bit about the differences, and I'm curious to see if there's any lessons that an advisor could pick up on their own thing, just off the challenges you're experiencing now.
Yeah, I think the long-term advantage that we will have that's different than being an advisor and trying to stand out in your community. Mm-hmm. And in Jefferson City, I think we're up to 18 or 20 Edward Jones advisors on top of everything else, that's
What's your
there.
population down there? Like 500,000? No.
I think the city proper is like 35,000, but
I overshot by like a lot.
By like a lot, yeah. Someone like Lowe's would look at the consumer base as a county and say that there's 60,000, people to sell into. I
always thought there's more down that way.
It's a big small town, which is one of the things I really like about it. But it's saturated when it comes to advisors. The point I was making about just Edward Jones and then everyone else that's there. But I think the benefit that I think we'll have long term is our track record is public. Whereas it's tougher for the advisor. Maybe with some of the new marketing rules, it gets easier to disclaim one's performance if you have models or something like that. But you can't hide from your track record.
No.
So we have tried to. Kind of rush into industry. We've tried traditional wholesaling. I think that is pretty much dead in the wake of COVID. I mean, I feel bad if you tell people your job is a professional wholesaler and you haven't been willing to innovate around that.
They have been, I get to deal with a lot of wholesalers, and I will tell you that they definitely especially during the middle of the COVID time, they were just itching to get back out on the road, and a lot of carriers and a lot of wholesalers couldn't get out by company policy until the beginning of this year.
And then, I'm glad I don't personally own corporate real estate in my portfolio. Many leases are being renegotiated or modified. And the advisor preference has been hybrid. They don't want to be back in the office full time. And so it's going to be different. How do you approach these people? But the benefit that we have is, as time marches on and new things happen, it may rhyme with history, but won't repeat exactly.
Yeah.
We have our track record, and that's really what you are. And I forget which coach said this. I mean, there's oftentimes you look at seasons,
sure,
and you might look at a team and say, "Oh gosh, they're only so many games, this many points away from having been undefeated or contenders." And at some point you go, yeah, but your record is what it is. I mean, that's kind of who you are. So as a fund manager, what we're betting on is that we'll be right, and as that happens, it will be hard to ignore that as a user. And so what you have to do in between then is live very humbly in terms of your expenses and make sure that you can exist long term. There's no point having a great idea if your business can't make it to that time frame. And then you try to be scrappy, so where you can one to many with digital mediums. But again, there you have to stand out because that's very noisy now as well. That's not a differentiator anymore. That's a have to have. But where you really have to stand out is your track record.
I think you'd have a competitive advantage if you can. So the challenge for you is the same challenge that you had as an advisor, just a little different. And it's the same challenge that, at Creative that we have too, is to get somebody to stop, look, and listen long enough to hear your message.
Mm-hmm.
And I would think that one real big competitive advantage that you have personally is the ability to say, hey, this is why, this is the fund, and here's our track record, but here's why it matters.
Nearly every I do a lot of our client-facing endeavors today. We're a small team, and so I take many meetings with potential customers, advisors that we distribute into or like to partner with. And I wasn't sure how to address that initially. Would they think that is does that make me an equal to theirs? Do they see us as an underling because of that? You didn't come from 30 years of fund manager industry. And where it's evolved is full circle. I start every conversation off with, be something like this. Dennis, I used to be an advisor. I'm a recovering advisor, whatever I might say to you. But I almost always, whether it's in person or Zoom, I see the shoulders relax. They at least know that I have something in common, with them. And I also, I'm trying to think of the lines that I probably repeat too often. I mean, they're sincere, but just, they kind of become your talk track. But as I was telling you a few minutes ago, the world doesn't need another fund manager to make it a better place. And I recognize that. And so if we can't add value to your practice, I know how often you get solicited because I used to be you. And I don't want to sit here and wait for a maybe. We're either going to add value to what you're doing or you think about us down the road. But I don't want to waste their time or, quote unquote, wholesale them. This is what it does. This is how it works. How might it fit into your practice? There's either a fit or there's not, and then we try to respectfully, bow out if we're not a fit. But
were you more, so when you say that, were you more did that follow, as you look back on your advising career, does that follow your style then? Were you more like, hey, here's what we do, here's what we bring to the table? Yeah,
listening is a good skill in all businesses. So you try to listen and find that need. But I'm probably direct. I think that's probably a personality trait that I have. And so if I come across that way, I do so because I hope that it just shows that I'm being sincere and honest. And hopefully not pushy. But, I think that the advisor on the other side appreciates that I have also had more voice messages from wholesalers that I didn't want or need to listen to.
Sure.
And the thing that clicks, what do our customers have in common who are using our strategies? They're curious people. The advisors that we really click with at this stage are people who are hyper curious. And what's neat about that, the financial advisory industry is built on a model where you can be uber successful financially in a residual compensation world. And it gets, I hate to say easier, but if you systematize your business,
absolutely,
it can get easier even in tough years, to make more than you did the year before. It breeds a lot of complacency.
Definitely can.
And that's just, human nature. And I think the complacency that I would be concerned about for the American investor today, that therefore becomes my concern for the American financial advisor, is the way we're building portfolios is kind of like your analogy of are we building the military for the last war. I think returns are going to be harder to come by, especially in the near future. And I think the market is going to be more volatile maybe than it has been. And I don't mean that it can't be rewarding, but you probably had a meeting with the client. If you're an advisor, you probably went through a client profile questionnaire and an investment policy statement and use words like, do you consider yourself conservative or aggressive? And what does that really mean? And this is where I think Mike Tyson was a great philosopher.
That's a great quote.
Everyone has a plan until they get punched in the face.
Yep.
And so I think advisors are going to get punched in the face a little bit here if they haven't, or if they don't already feel that way, this year. But returns are going to be tough to make. And if you're wondering why that was possible in the prior 10 to 20 years, you've got to go back to that 2008 timeframe that I told you about, where you go, oh, that's where we set off this brand new experiment of quantitative easing, zero interest rate policies, TINA, there is no alternative, to stocks. Have you heard that acronym? I'm sure.
Actually, I never have. TINA.
TINA. There's no alternative to, to equities or to stock or to risk. Well, that's over. But I mean, that was common cultural terminology just 2 years ago. So you're going to see a world where bonds may be more attractive to clients than they were. I mean, something that, again, rhymes with maybe the 1980s.
Yeah.
I think private offerings are going to demand at least an educated opinion. So I see advisors being challenged on, okay, if you got your cookie cutter 60-40, what makes you different than the last person I talked to?
What makes you different? Is it just your fee?
Yeah. Right. And all those things get commoditized and squeezed over time. But curiosity, that's right. I keep going back to that's the thing that where I'm really clicking with advisors, and I guess it's self-serving because they're curious enough to use an unproven maybe or new fund manager, but they're curious enough to say, well, that's interesting. Pop the hood. Yeah. Now I want to see the timing of the engine and who makes that and how are decisions made in the portfolio. If we're getting to those level of questions, usually we convert them to a customer. If someone just says, hey, I have a rigid look back process, you needed to be the best fund 10 years ago. Yeah. Well, then you're probably fighting the last war. Yep. And we're not going to be a good fit. So when we're 10, I'll call you. But until, if you're still around at that point in time.
That'll be interesting. And that is really neat to think about, the fact that your numbers do as your funds. I mean, it is track record. Before we pivot, I want to pivot and talk about the future and what you see coming. But as you look back, let's take a look back from where you sit now. So it's been, how long have you been doing build on the build side now?
Well, January 1 of 19. And
so about three?
About three. We, just over 4 as a business, but almost a year just to stand up the things that allow you to play in the capital markets, get registered as a firm, pay Bloomberg and get them to take your calls, and just access institutional trading desk as an example. Yeah. But the fund itself, the strategy, just under 3 years.
Okay. So as you look back now, so for the advisors that are listening, so as you take a look back and reflect on who you were and how you did your business back as when you were doing individual, when you were in private practice then. Let's call it that. So what insights would you have to your former self? If you were calling back, you pick up the phone and you're talking to 2008, and you're just like, hey, John, this is John from the future. I have a couple things I want you to know. What kind of stuff would you tell yourself from this perspective?
Well, it depends on which chapter I think we're, visiting with our prior self about. If it was how to sell your practice and get the most multiples. I mean, I've been amazed by the aggregation that's taking place.
A lot of it.
In the business. Yep. That also is going to slow because cost of capital is going up every time Jay Powell speaks. Yep. So that would be a chapter. How do you position your business for transitions and success? Or if you're a younger advisor like I was on the SKU chart, how might you find businesses that are thinking about exiting? If one of your plans for growing your business is scaling through acquisition.
Did you do any of that?
No, I had just started to really look at it when the build idea became real.
Gotcha.
But I would say this: had I pursued it, I'd have been wildly wrong. Because when, on this side, people actually will open up to you and tell you a little bit more about the inside baseball of what kind of multiples, what kind of deals they're doing for their shops, and I would have been wild. I wouldn't have won. I would have been wildly under.
You think you've been overpaying, or
no? I couldn't have played because of private equity paid up in a way in this space in this period of time that is would have made my head spin. Still makes my head spin.
Yeah.
But, acquisitions are still going to continue, but I think you're going to see some of those multiples compress and become a little bit more realistic. Just like your home, getting $100,000 over offer with no contingencies and escalator clauses. I mean, the housing market has changed.
You can have my house now.
Right. That's kind of where practices were during the pandemic, and then so that's not quite where it was. But that could be a chapter. How do you scale? How do you think about your practice as a business owner? Technology and tools. I want to be self-reflective. So we're the new guy. So these backward-looking systems do not favor us because we don't have that 10-year track record.
Yeah.
At the same time, this concept of a fiduciary has really been bastardized. You can't be an omen. You're not going to have a crystal ball.
Exactly.
But I do think we have to have. It goes back to that term again, curiosity. Yesterday's performance is not going to get you through, the market of tomorrow.
That's right.
And I read a report the other day about how the stock market, what X% higher it was, Y number of years after the last two crashes, and it's summarized, and so we believe that's going to happen again. Well, on what time scale? One that you have time to wait around for, that my dad has time to wait around for. We have heard the 1970s quoted a lot here. Volcker and Powell's names get brought up a lot in conversations, right? And again, history rhymes but doesn't necessarily repeat. Where's that growth going to come from? That was necessary to help get us out of the last one. Just the debt to GDP load is different. The workforce dynamics are different. And so I do think it's going to challenge advisors to at least scrutinize. And 60-40 is the thing that you've heard for the last 2 years. I think is it dead or is it still going to work? It's going to look different, and it's probably going to look different in the same way. Go back to sports. That positions evolve. And I think while we can't agree on the best college team, we're both Chiefs fans.
Sure.
Mahomes is changing the way young kids think about the quarterback position.
Yep.
And I think you're going and why? Because that's a response to the threat of defenses and better cornerbacks. And so back to your war analogy, advisors are going to be forced, I think, to retool, some of their offerings.
Yep.
And also, I don't know how you sustain going forward a professional advisory practice if you don't also invest in macro and microeconomic understanding and philosophy. I could see that getting more centralized. I think it's harder for a one-person organization to be a financial advisor in the future without some tremendous tools to help them, at minimum, be able to demonstrate to their clients that they've got, a little bit of a history degree so they can talk about what this rhymes with in the past and why they're making the decisions they do. But I think you're going to see more and more customers. And I also like asking the client, the investor, what are you looking for in an advisor? And they're also being more candid with me. What are you hearing?
Did you hear anything that surprised you?
I'm hearing more and more people say they're not going to put up with the set it and forget it attitude. And I think that gets back to just this whole we're not an organization who makes big tactical decisions even in our fund about predicting the direction of a stock or a sector. But I do think we're going to see some things here that call for an advisor to communicate to their clients why they're repositioning the portfolio. And so you could see people who are good at active management really add some alpha to portfolios where indexing hasn't been able. Indexing has, by virtue of a zero interest rate policy, it has a 20-year big-time head start on all the backwards-looking charts. If that doesn't remain in vogue, it won't tomorrow.
I think people, I think people want to see There's so much when you think about news cycles. There's so many things that are moving, and things need to, how are you reacting to this?
Mm-hmm.
And if you're an advisor, if you're not communicating and letting people know that you're on top of it, the patient advisor who just puts the money in, or the patient investor who just puts the money in and just leaves it, that patience isn't there anymore. Where there needs to be activity.
The lack of financial literacy is allowing for some of that complacency to exist because the client doesn't know any better. Mm-hmm. But I do think if advisors are being honest with you, I suspect over the next 24 months, if it hasn't already happened, you're probably going to have advisors, if they were being honest, who would say, yeah, I lost 1 or 2 clients that I didn't think were at risk of being lost because they just weren't happy with lack of communication. Or, and it could have been, hey, we're not doing anything different, and here's why.
Yeah. They just need to know.
Yeah, because I think the everyday person senses that it's different. Mm-hmm. And I think a big eye-opener for me the other day, this was about a month ago in the grocery store. I was at the deli, and a guy ordered 6 ribeyes. And they got put on the scale and wrapped in the brown paper and weighed, and the price came up. And
I can't wait.
And he was very embarrassed, but he walked forward, but quietly, but loud enough that I could hear. And he said, "I'm sorry, I can't afford that. Can you put those back? I need to get ground chuck instead." And gas prices is the thing that I think people talk about the most, probably at their family gathering tables and so forth, or it seems to be the topic du jour that politicians point to. But when people start it is so widespread right now, and we're so far from being able to actually put our finger on the pulse of the why. Mm-hmm. And remember, just 9 months ago, the Fed was saying transitory every meeting, and now that's a curse word, right? Yep. So it is the credibility of the system, and this is the Bitcoin conversation. This is what even gives it the ability, to exist in this ecosystem. But people are questioning the credibility of the financial system, even if they don't know what they're calling it. It doesn't feel right, and I think that is going to find itself walked all the way up into the, hey, are you the right advisor to serve me? Question, that clients are having. So yeah, I think you're going to see some dislocation, unfortunately, because of financial literacy and residual incomes. I don't think it's going to be enough to get a lot of advisors to change. Yeah. But I think some will, and in the years to come, I think they'll really stand out. Obviously, planning, and that's kind of an older, leg to the stool that had been missing. But I think people who do sincere financial planning, there's a lot of alpha to be had there, which goes all the way into tax planning and estate planning and things like that. You see that branching out more. So as an advisor, you need to bring more to the table. Oh yeah, yeah. It's an arms race. I mean, there's a group here in the Kansas City area who is growing very quickly, and it's all about planning, for them. And that's just one example of a firm who's leveraging that. But if you're trying to take one of their clients away and don't even offer that service, good luck. Yeah. Yeah. What do you say? So looking forward, putting on your Punxsutawney Phil hat, as you look forward, from your perspective now, any bold predictions you want to make? Any semi-bold, or just observations? I probably have to stick with observations for the compliance. Even I have compliance people. Exact quotations. Exact. They're going to hold you to numbers. Let's get some numbers out here. Again, we do backing up. Who was it? Reagan. Every generation, unfortunately, has to relearn the hard lessons, and I think we're going through ours right now in a financial sense. Most people, my point about financial literacy we usually think of as what is a stock, what is a bond. Sure. But history and financial literacy, most people can't explain to you what actually occurred when Nixon took us off the gold standard, and when that happened, and why, and what were the repercussions of that. But that was a financial reset. And World War II was a financial reset. And we may be going through a financial reset. I mean, just observations. A lot of this history is rhyming. It's not repeating because some of the other dynamics are different. The global powers are different. The geopolitical pressures are different. But observations. We may be going through a financial reset, and I don't have a crystal ball to tell you when, where, why, or what comes next. But those can be painful, and they can be hard lessons to learn. And a lot of people don't even know what game they're opting into.
Yeah, exactly.
The other is we are absent a serious energy policy, and that's, I think, going to lead a lot of this. What happens next? We're addicted to petrofuels, and when I say addicted, I mean like
everything's built on it.
Nothing is operating without them, and we want to do a light switch flip to something else, and we could debate whether that's the pros and cons of that. But the practicality of the light switch flip is putting people who have very different value systems than ours. It's giving them a lot of power, and it's putting us in a less strong economic and therefore probably also political position to negotiate. And negotiate means our future financially, also. So think a veteran, because right now, if you wake up in America, you're lucky to be back-to-back World War champs.
Yep.
And so even though things are bad here, they're going to be worse, other places. And but those would be my observations. Is I think strange things are at work right now in our financial system. It is going to evolve. That would not be new or even that bold of a prediction.
Sure.
Because it's happened. We just kind of forget that these resets have occurred.
Yeah.
I think there's going to be a totally different discussion about green and how we code things as green, because there's nothing ethical about seeing humans die. And I think we're going to see a lot of human lives at risk because of the lack of an energy policy. Europe is realizing that right now as they put more and more coal mines, back online.
Yeah.
And why does energy matter? Because the money's all tied to energy, and everything that we do is tied to that. So I think that's going to be something to pay very close attention to. And there was a third that I had.
What do you think about?
Kind of popped out there.
What do you think about? So I'm a novice on it, but what do you think of the world of crypto? And I mean, that's definitely something that was going to be coming up. Is it not?
The
currency issues.
Things I learned in 2022. The like kindergarten version of the book is a good old fashioned scam. It's just a good old fashioned scam. So can't wait to read the book.
On SPT or whatever his name is.
More realistically, watch the movie.
Sure.
On
like Netflix or something.
Yeah, SBF.
SBF. There you go.
It's early. We're just scratching the surface, but it has all the markings of just a good old fashioned scam. And the more I have looked at and researched the topic of crypto, which is just one of the things I had to learn, is cryptography. Say that 10 times fast.
Maps, isn't it?
Well, the idea of coding, hard to break code, cryptography.
Oh, gotcha. Yeah.
Is where that is the root word of the term crypto, and then that gets back to the idea of the blockchain and how that is all put together. But I think what we're going to learn, lessons from 2022, is that there's Bitcoin on chain that you can see, that's in a wallet, and then there's everything else. And we could bring other people on to debate me about what else deserves to be in the everything else category. But decentralization is really the theme and the value of crypto. The original crypto was Bitcoin, and what you had here was rehypothecation of people's money and commingling of assets, and these things have always been bad. And it's not really going to be a crypto story as much as it was just a scheme.
Yeah.
And stealing from people.
Just a different, same scheme, different
apparatus.
There you go.
Yeah. But so this is definitely crypto winter in terms of, you look at, price movements. But I think people actually look back from this and say, oh, Bitcoin was fire, or Bitcoin was the wheel. It was the new invention. Where is it useful? And I don't see much value in these others, personally.
The other one's following along.
Yeah, I don't think you're going to find value in society for those. I think Bitcoin has a place, and the more I look at it, the more I believe that.
That's interesting.
But owning it in your wallet. So there's have you heard this phrase? Not your keys, not your coin.
Mm-mm.
So that's the concept that if you don't store Bitcoin and take possession of it,
sure,
the same way you take possession of a bar of gold and say it's safe, I have it, I know where it is,
right,
then that is Bitcoin, and you know where it is. But this concept of it's money on a ledger, that you just buy from an exchange, that's one of the hard lessons of this year. That's not safe, and so I don't think that's going to be welcomed. I think the regulators we're way behind, but they're going to make big changes there. But where Bitcoin has value is in that ledger, is in the system of where you take possession of the coin, and that was actually the original intent. If you look at Satoshi's papers, he never theorizes about exchanges and IOUs to Bitcoin.
It's such a fascinating area, and it's one that I will candidly admit my ignorance on a lot of it. But it the way things look, it looks like it's definitely going to be part of our future.
Yeah,
in some form or fashion.
Well, and that's kind of what I meant by reset. There's a lot of people who I've seen. There's a great clip. I'll send this to you after the show.
Sure.
I think it's Katie Couric, like 1993, her and Bryant Gumbel trying to explain the internet.
Oh, yeah.
Do you recall this?
I do vaguely recall it.
So they're reading the teleprompter, and it's, if you have questions or want to write into the show, and then what they're used to seeing is a P.O. box, right?
Right.
Send us a letter here, and now the teleprompter says, send us an email. And someone stops and they say something like, hey, what's that A with the curly tail around it? And someone else goes, well, that's the internet. And so they're trying, it's very clunky. Mm-hmm. It's 1993 though, and they're trying to explain the internet. And some people in this clip say something like, that's just too much. I don't even want to, I don't want to make that a part of my life, as if it was a choice, some years later for those folks. But I suspect that's kind of where we are right now in our understanding of the crypto industry.
Yeah.
And again, I personally differentiate
Bitcoin from the rest.
Bitcoin from the rest. There was a Fidelity research paper actually that came out simply titled Bitcoin First. And I think it does a really good job for financial traditionalists and your advisor audience. If you Google and find that, why it'll lay out, I think, pretty easily as just one place to start. If you haven't done any research at all, again, curiosity. Be curious. The world's changing. I do think that you're going to want to educate yourself on, at least be able to tell your clients and defend your opinion. Yeah. What is this? Is there a place for me?
I think that's when you get old in anything in life, is when your willingness to learn stops. Then time just right at that exact moment. That's when time passes you by.
Did you watch any of the Ted Lasso series?
Yeah, I did.
That's one of his quotes in that show, which I love. There's a scene where the old owner of the team comes in and challenges him to play darts.
Yeah, the dart scene. Yeah,
and he sets him up by throwing left-handed, and then when he comes in to play him, he throws the correct hand, and he's aces, and he's just like, well, if you were curious.
I remember that whole scene.
You'd have learned that I did this with my dad, every weekend, and that I've been playing darts for so many years. So that may be where I picked up that term, but that's kind of one of his sayings as a coach throughout that show is be curious.
It's a good saying. That is also a beautiful spot for us to end this conversation. That is a great final thought to stay curious, because I could sit here as a curious person and talk to you all afternoon.
Likewise.
We're going to have you on the show again if you get a chance to come up. We'd love to have you on here, but thanks for being on here.
You didn't ask me the most important question.
What's that?
Well, the answer is Q39. The question is, which barbecue did you have for lunch today while you visited Kansas City area?
That is true. Hopefully you had in my opinion, their burnt ends. Their ribs are great, but their burnt ends are amazing.
Yes, I did go burn ends.
They're good stuff. Okay, so thanks for being here. Don't forget to like and subscribe, and we've got new episodes coming out all the time. I always forget to do that part. So, John, thanks for being here. We'll call it a wrap.
Yeah,
boom.
It was fun. Thank you.
This podcast is for financial professional use only and not for use with the general public. The information provided is the exclusive property of Creative One and is protected by copyright and other intellectual property laws of the United States. This material has been prepared for informational and educational purposes only. It is not intended to provide, and should not be relied upon for, accounting, legal, tax or investment advice. Creative One is not responsible for the results of programs discussed on this podcast or any liability stemming from the use of it. Although we may promote or recommend the services offered by this company, agents are ultimately responsible for the use of any materials or services and agree to comply with the compliance requirements of their broker-dealer and registered investment advisor, if applicable, and the insurance carriers they represent. Copyright 2022, Creative One Marketing Corporation.